Welcome to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, here's this week's market wrap with commentary and analysis from the low-cost precious metals dealer voted best in the U.S., Money Metals Exchange.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up, top trends forecaster Gerald Celente of the Trends Journal joins me to discuss a myriad of topics. Gerald gives us more insight on why the precious metals are struggling, why he recently changed his economic forecast, and also shares why he believes a continuation of the rising tensions in both Venezuela and the Middle East could lead to a spike in oil prices that the world simply cannot afford. Don't miss another wonderful interview with the great Gerald Celente coming up after this week's market update. As global stock and commodity markets gyrate, gold and silver markets are gaining some safe haven strength. Gold prices moved back into positive territory on Thursday, but is little change for the week now. The elemental is up a slight 0.4% since last Friday's close to trade at $1,284 per ounce. Silver has been beaten down this spring, but it is at least showing some signs of life here during the latter part of the week, or at the very least has appeared to stabilize a bit. The white metal is now up 0.9% for the week to bring spot prices to $14.61 an ounce. Turning to the platinum group metals, platinum registers a weekly loss of 2.2% to trade at $805, and finally palladium shows a 0.7% decline to come in at $1,332 per ounce as of this Friday morning recording. Crude oil prices plunged 8% this week on the heels of rising U.S. inventories and fears that trade wars will crimp global economic demand. An even more dramatic move was seen earlier in the week in some of the so-called rare earth metals. Rare earths and related equities catapulted to the upside as rumors spread that China may seek to restrict exports of these critical elements.
There's speculation that rare earth elements will act as the next bargaining chip for China in the ongoing trade war with the U.S. after President Xi Jinping visited a local company specializing in the sector earlier this week.
Rare earth, they're a collection of about 17 elements, and when they're processed in their mineral form, they turn into these industrial chemicals that are absolutely critical for things like magnets and motors used right across the electronic sphere. You know, these are things that are contained in missiles, to electric vehicles, to wind turbines and consumer electronics. They really are absolutely ubiquitous, throughout the devices that we carry around and rely on. So clearly, any move to restrict exports out of China, to restrict the flow of these materials into the US would be very problematic for the US. The US relies on China for about 80% of its imports of rare earths.
Beijing currently has a stranglehold on over 80% of the global market for rare earth metals. The Chinese have previously leveraged their near-total control to win concessions in geopolitical clashes. In 2010, China briefly blocked exports to Japan over a territorial dispute. Trade wars can quickly escalate into resource wars. With U.S. domestic oil production continuing to rise, America is relatively secure on the energy front, at least for now. But when it comes to rare earth metals and precious metals, the country remains heavily reliant on output from hostile and unstable countries, including China, Russia, and South Africa. South Africa is a major supplier of gold and the world's leading producer of both platinum and palladium. But in recent months, mining output has been declining. Fears of a chronic supply deficit drove palladium to record highs earlier this year. No such move has occurred in the other precious metals, but they too face potential long-term supply shortfalls. Many mining industry analysts believe peak gold and silver have arrived. If so, then global production of precious metals will enter a period of annual declines. Prices are disconnected from this fundamental threat. The currently low prices further disincentivize exploration and development of new mines. At under $15 an ounce, some primary silver mines are actually producing at a loss. This situation obviously can't sustain itself for long. Historically, when a metal sells for right near its cost of production, it tends to be a good long-term buy. But the silver market will put your patience to the test. Lately, it's been consigned to the bargain bin. It won't stay there forever, but for those who simply want to accumulate ounces of hard money at the lowest cost, The bargain bin is the place to shop. If you don't mind buying silver products that may be tarnished, scratched, or dented, then you'll want to check out Bargain Bin Silver from Money Metals. Our Bargain Bin Silver includes a mix of pure silver coins, silver rounds, and different silver bar sizes, all as close to the spot market price as possible. Bargain Bin Silver is for those investors who know that silver is silver and know that it's prudent to pay as little over the silver spot price as possible. Our Bargain Bin products come in any variety of forms. They could be highly scuffed sovereign minted coins, or they could be unusual silver rounds or bars that we do not carry in bulk, but they're all pure silver, and that's what matters most. Maximizing the number of ounces you get for the money is always going to be a winning strategy in an up market. If silver prices rise substantially, the value of your silver will rise in tandem. With any luck, you'll be able to sell back into the market when silver is a hot commodity rather than the bargain it is today. Well, now, without further delay, let's get right to this week's exclusive interview. It is my privilege now to welcome in Gerald Celente, publisher of the renowned Trends Journal. Mr. Celente is perhaps the most well-known trends forecaster in the world and a regular guest on many financial programs, including right here on the Money Metals podcast. Mr. Celente, it's a pleasure as always, and thank you for joining us again.
Always my pleasure to be on. Thank you.
Well, Gerald, stock markets flinched right after the recent announcement that tariffs on Chinese goods would increase to 25%, but stock prices have since resumed the rally for the most part that has been going on since last December. At this point, we don't know what it would take to make stock investors cautious. Trade wars, PE ratios at epic highs, escalating tensions with Iran. There was a time when these things might have worried some people, but not today. It isn't even clear how many actual quote-unquote people are making buy and sell decisions in the equity markets anymore with all the high-frequency trading going on. What do you make of the action in stocks? Do you think what we're seeing is an honest market? Are real people making judgments about what and when to buy or sell, or have artificial forces completely taken over? Basically, give us your thoughts on the state of the stock markets here, Gerald, as we begin today.
Well, it's a combination of the two. Back in September of 2018, we called for an economic 9/11. The reason being is that the Federal Reserve said they were going to aggressively raise interest rates. The next day, the S&P 500 peaked on September 20th. Then the market started to decline. We saw bear markets going down 20% around the world. The United States, the Dow had its worst December since the Great Depression. Then on January 4th, 2019, Fed Chair Jerome Powell, after we had strong employment numbers, 300,000 plus joined the employment force, the wages increased the most in 10 years for the entire year, he announced that they were going to be, quote, patient in raising interest rates. And we did a 180-degree turn on our forecast, and we said the market's going to go back up. It's very simple. It's monetary methadone. More cheap money that they're throwing into the system. And so what happened? Well, we go back to this just less than a month ago. The S&P 500 and NASDAQ hit all-time highs. And now, again, they backed off with the talk about trade war. The trade war talk is nothing but talk. They've been saying this now for 3 years, and the markets keep hitting new highs. It's not going to bring the markets down. What's going to bring the markets down is, number one, our higher interest rates, because all this is letting gamblers gamble cheap, and particularly in stock buybacks, which you saw a record last year. We're headed for another record this year. So they're borrowing money cheap, buying back stocks, driving up the markets. We just came out with a new edition of the Trends Journal, and our economic forecast is that, yes, there's going to be a recession, but not this year, because we're hearing, well, the Fed just came out again, said no rate moves are coming for, quote, some time, even if the economy improves. So when people ask, does the president have power over the Fed? Well, obviously they do, because Trump has been pushing the Fed to push down rates, and now they say they're not going to raise them. And when you go back to Richard Nixon telling Burns not to raise them before the election, Paul Volcker, the former head of the Federal Reserve under the Reagan administration, in his last book, saying that he was brought into the White House and told by James Baker not to raise rates before the election. We see what's going on in Turkey, whether it's India, you name the country, yes, the president has power over the Fed. And we're going into this is the presidential reality show in the United States. Trump wants to get reelected, and he's going to do everything he can to keep rates lower, to keep juicing the economy. So it's basically cheap money that's pushing the markets up. Our forecast is the markets are near peak because we're also seeing in our forecasts that corporate earnings are peaked. So that's where we see it at this moment. And yes, a lot of it's algorithm, but it's also, they're the real players behind it as well, making decisions. So it's a combination of the two. But again, we're seeing now there's basically a global slowdown. The only reason you're seeing markets going up around Japan and China and in the United States is cheap money, more quantitative easing at different levels, and of course negative bond yields. And now we're hearing the OECD coming out and saying that in Europe they have to do more to stimulate the economy. So it's going to be artificially propped up and that's all it is an artificial market. And they're going to keep propping it up as much as they can.
Staying on point there, to the extent we have seen artificial forces take over, what do you think that will mean for people, including metals investors, who are still investing based on fundamentals? Would it be wiser to just throw in the towel and stop, fighting the Fed, so to speak, buy stocks, buy bonds, and sell gold? I mean, we've seen some clients doing that, and their logic isn't hard to follow, but it seems to us people are forgetting that central bankers don't always have a stellar track record. They blow bubbles, and bubbles inevitably pop. That said, we suppose it's worth examining whether this time may be different. So tell us what you think. Is this time different, Gerald?
Well, no, it's not different. It's just it's going to take longer. And the debt bubble, that's the other part that we wrote in the Trends Journal, was at over $250 trillion. And you're hearing warnings coming out from the IMF about corporate debt and personal debt and government debt. And you're also having warnings coming out from people like Bain Capital, a warning about the great corporate debt that's been taken on because of mergers and acquisitions. So let's go back to the program again. And what happens? Well, if interest rates go up, how are they going to pay back this debt? So the fact is they're going to keep interest rates lower. And as we said, we're forecasting the Fed is going to lower interest rates this year and next year, if and when the economy slows down. And we believe it is going to slow down because you're looking at situations here where it just cannot sustain itself with higher interest rates, and it's true for around the world. And you don't need any more clearer facts than go back to last December. We saw home sales, for example, in Southern California plunge 20% when the 30-year mortgage hit around 5%. Now what's the latest news? Mortgage refinances surge 8%. You know why? Because the 30-year mortgage now is at around 4.33%. And we believe it's going to go under 4% by the time the elections in 2020 in November. So, no, the bubble's going to pop at some time, but what's going to make it happen will probably be a wild card event. We just don't know what that's going to be. It could be spiking oil prices. It could be war, as ramping up in Iran and with Venezuela. But gold is the safe haven asset, and right now the prices are stuck where they are because there's no feeling of a safe haven need at this moment.
We aren't far off from the 2020 campaign cycle really kicking into gear. We're less than 18 months from the election, and it's hard to know what things are going to look like, say, a year from now in terms of the field of Democrat candidates that will challenge Trump. Give us your thoughts on the election cycle trends that you're looking at, Gerald. What are some of the main topics on the campaign trail as you see it? Will we see a true socialist become the Democrat nominee? Talk about that and anything else you might want to comment on regarding the campaign silliness. Let's hear it.
Well, our forecast at this moment, again, it's in the Trends Journal, it's all about swing states. It's as simple as that. Trump didn't win the popular vote, he won the swing state vote. And what we're seeing now is that the majority of society on the Democratic side, they want stability and tranquility and safety. And that's why you're seeing Joe Biden leading in the polls. The millennials, which have a voting population almost the size of the baby boomers, are pro-Bernie Sanders, but only by about 2%. So going back to the swing states, it looks like, again, it's hard to say at this time. There are so many wild cards between now and a year and a half from now when the elections come. But if the elections were held today, and remember, we were the first magazine in May of 2016 to pick Trump the winner, we would say it would be Biden, because Biden has strong swing state support, particularly in Pennsylvania, where he was born, and he plays the card about he's Uncle Joe. Everybody loves him. He hugs you, he shakes your hand, smiles, says nothing, and knows how to play the game. And that's what the people are looking for right now. So we don't see it being between a socialism and capitalism, although we're seeing more and more people swinging toward, as the polls are showing, wanting to be more socialist. But again, it's the presidential reality show, and we have to see the way the acts play out, particularly with the debates. But at this time, if the election were held, we would say Biden would beat Trump, because Trump will probably lose to Biden in key swing states such as Ohio, Michigan, and Pennsylvania.
If you are going to get a hug from Biden on the campaign trail, just make sure you keep it short. Update us on the latest news and trends that you're seeing in Europe, Gerald. Is it still a hotbed over there with the Yellow Vest movement in France and the contention over Brexit and other social and political issues? Give us your thoughts.
Well, when you look at Brexit, you can see what a freak show most governments are, including ours, and you name the country and it's another freak show, Yellow Vest as well. The big thing to watch right now, Mike, are the European elections, the European Parliament elections that are coming up beginning next few days, to see where they go. And if you start seeing more and more going toward the populist movements, whether it's the Five Star Movement or Lega in Italy, or in France with Le Pen's party, or the Alternative for Deutschland in AfD party in Germany, it depends what we see there. That's going to be a real key element of where it's moving. If it stays status quo, and that's what you're going to get, things like Yellow Vest and the Brexit movement will quiet down. And again, going back to the presidential reality show in the United States, there is no movement for a new party, for a new way, and a new type of system. It's just more of the same. And so we don't see much change happening in the United States. But it's very important to watch the EU elections that are going to be happening this week.
How about metals here, Gerald? Do you see the headwinds continuing to weigh down gold and silver, or will we eventually get the spark that we've been looking for in order to finally get them moving to the upside? I know you've been talking about the 1380, 1385 level in gold being that key mark that we need to take out. We're about $100 below that as we're talking here on Wednesday afternoon. Talk about the metals and what you're seeing there.
Well, just to make it clear, I'm heavily invested in metals, so, it's not like I don't want them to go up, but I call it as I see it. And I've been saying basically the same thing now for a number of years. And that is that gold has to break. You meant the 1385 mark to hit 1450. When it hits 1450, then it goes to 2000. We need an event that has to bring gold up to the level of being a safe haven asset. And again, the ones that we see happening that can do that is what's going on with the United States against Venezuela, and particularly against Iran in the Middle East. Because if war breaks out in the Middle East, you're going to see oil prices spike to above $100 a barrel. The globe can't afford that. So what does that mean? Well, the dollar's getting stronger. It's not getting weaker. That's another reason why gold is staying weak, because the stronger the dollar goes, the weaker gold goes. So going back to oil, as the dollar gets stronger, many currencies are declining in value dramatically. So when oil prices are petrodollars, if your currency is getting weaker and the price of oil is much higher, you have to pay a lot more for your energy. The more that goes into the gas tanks, the less goes into the cash registers. So that's what we see as a kind of a black swan event that could drive gold prices higher, and that is if oil prices spike. Because it's very important to remember, Mike, that the last 5 recessions were preceded by spiking oil prices. So that's the one that we're looking at the most, as well as war. But as far as the economic fundamentals as they are, we don't see the debt bubble popping as long as they keep pumping more money into the system to artificially inflate it at this time.
Well, as we wrap up here, any final thoughts or anything else, any other trends you believe people should be focusing on or looking for or paying attention to as we move into the middle part of the year?
I think we've covered it pretty well. It was very important in talking about this is not to buy the lines that the media and the government are putting out, that the media is just repeating, the prostitutes as I call them, because the people in the media just get paid to put out by their corporate johns and their Washington whoremasters. So people are being led in directions without substantial knowledge of the facts, and they're just following the lead that they're being taken on by the government or by special interests without knowing the facts behind them. So as this war talk heats up and the war drums keep growing louder, stay in tune to the current events forming future trends. And of course you could do that with the Trends Journal because the media is not doing that. But it's very important at this time because we're very concerned about the direction we're going in now.
Well, we'll leave it there, Gerald. We always enjoyed and appreciate the time once again today. Now, before we let you go, tell listeners a little bit more about the wonderful Trends Journal and any other information they should know about the Trends Research Institute and the various ways that they can follow your work on a regular basis.
Well, the Trends Journal is a monthly. We just came out with a new edition. And, of course, we do Trend Vision 2020 podcasts and Trends in the News broadcasts. So you get those every weekday night. And we do trend alerts each week, and it's only $129 a year, money-back guarantee. It's the only magazine, only information source in the world where you'll read history before it happens.
Well, thanks again, Mr. Celente. It's a pleasure as always. Take care and enjoy the Memorial Day weekend.
And thank you, Mike, and thanks for all that you do.
Well, that will do it for this week. Our sincere thanks again to Gerald Celente, publisher of the renowned Trends Journal. For more information, the website is trendsjournal.com. Be sure to check that out. And check back here next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Gleason with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.